Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to the Sunday Roast, Sunday the 13th of March, and we're back after a short but well-deserved break. How are you doing, Kev?
I'm doing good, mate, and you?
Yeah, you don't sound it. You sound a bit down, a bit more enthusiasm. Come on, we're back.
Oh yes, we're back! Hallelujah!
Brilliant.
Yes, it's basically the. I don't want to sound down, but the news has been pretty depressing, hasn't it, for a couple of weeks, and that's one of the reasons why we took a bit of a break, because we didn't really see it as appropriate to be pushing anything at a time when people basically losing their lives for what, you know. So, but we won't talk a lot about that anyway, because we're not going to solve.
Well, there's enough on the news out there, isn't there? You almost want to trying to switch the news off at the moment, but naturally, it's been a tumultuous time for the markets, and we're seeing a real hike in those commodity prices and natural resources. I think the price of barrel of Brent crude soared as high as $139 at the start of the week, but slid to around $110 at the moment, as two key OPEC producers signaled they were ready to turn the taps on, easing the inflation fears that have stalked global market. What do you think about that? I mean, what do you think about the price of oil at the moment?
Yeah, well, the price of oil, living in Egypt, we haven't had any hikes because it's sort of fixed price by the government. But I've seen lots of pictures from people and complaining, people going to the gas station or the petrol station, and it's crazy prices, you know, per litre. I think we pay 45p a litre all in. And, you know, I've seen people paying £2 a litre, I think it's or close to this. Crazy prices. In reality, if the barrels are not there, then there's going to be a shortfall, and obviously the price is going to increase. And it's not just oil, really, is it? We've seen many other assets. You know, you've got gold has gone over $2,000 an ounce. I don't know whether it came back under again, but it's round about that figure anyway. We had an increase in copper. We had an increase even in, I think, graphene. All nickel was going crazy. All the things that are going to be battery metal based, really did rocket. But the fact is, whether we like it or not, the world has hopefully realized through all of this that we're going to need oil for the next 30 to 50 years minimum. Yeah. It's not like a transition to green overnight. That just does not happen. And I think a very good example of that is the coal price. I mean, what's been happening to the metallurgical coal price? It's gone crazy.
Yeah, it's gone. But I mean, I think just coming back onto the comment you made, the reliance on other countries, in particular Russia, for the oil, do you think it's going to be, the government has already made an announcement that they really want to focus more on homegrown territories for their oil. What do you think about that?
Well, I think if we go back, 40 years, maybe 50 years even, when the North Sea was at its peak, and we had huge oil production from that, and we were sustainable. We didn't need oil from anywhere else. And we've still got plenty of oil in the North Sea. So at the end of the day, why aren't we using that? So, there's a big issue now. Is it going to be more around energy security for countries than actually just the energy itself? Now, obviously, there's going to be a story in that with wind and with solar and, you know, producing hydrogen. We were talking about hydrogen utopia and PHE and Equitech or whatever they're called. You know, all of these different ones that can use waste to produce energy, but they're only beginning. You know, we see that there's fantastic potential there, but they're only beginning. So if you've got a company now that actually has the oil and has potential to get that oil out, then surely that's got to be worth a huge premium, and especially one that is based in the UK, you know. That would be my take on it.
Do you know anybody who maybe, you know, an oracle on this and can comment on this particular space?
I have no idea, Phil. So if you know someone, let me know.
Well, hang on a minute.
Oh, who's that? Is it knock at the door?
Who's that?
Yeah. Hi, it's Steve.
Steve. Welcome, Steve Brown, CEO of Orcadian Energy. How are you?
Very well, very well. Very nice to meet you. Good. I was just walking past and I heard
you heard us chatting. We were at the bar. We were at the bar and you heard us.
Yeah. I thought, I know something about that.
I've been doing that for the last 40 years.
Go for it, Steve. I mean, what are your thoughts on the reliance now on, obviously, the over dependence on Russian oil and foreign oil?
It's been a really odd time in the oil and gas business because, when I joined the oil and gas business back in 1981, the big thing every young graduate wanted to do was to become a North Sea tiger and be involved in this vibrant industry that was going to deliver massive profits for the nation and so on and so forth. And I actually joined BP back then, and I spent 14 years working for BP. I did get to be a North Sea tiger very briefly. I had a year working offshore in Forties Bravo. That was fantastic to do. I can't really claim to be a North Sea tiger, but anyway, that's where I learned my engineering chops. It's been really strange to make that transition from being one of the most exciting industries in the UK to being one of the most vilified industries in the UK. The whole demeanor in 2021 with Stop Cambo and, don't invest in oil and gas. Everything has to be renewable energy only. That's been a bit of a shock to the industry, actually. Yeah. And, the industry is very responsive to what society and government want. So it may not look like it, but we actually are. And what happened in 2021, which really matters for our company, is the Oil and Gas Authority basically said to everyone who's trying to plan a new development in the North Sea is you got to get on and do it, but you got to do it in such a way that you're absolutely minimizing the emissions involved in that process. And you probably, your listeners probably haven't heard of our company, because we haven't been called Orcadian Energy that long. We renamed ourselves Orcadian when we listed because our previous name was Pharos Energy. That was named after the place nearby I was born. But we would have got ourselves muddled up with Pharos. So we had to come up with a new name. And we did that when we listed. We've actually been around about 7 years before that as a private company. And what we did as a private company is we built a portfolio of licenses in the central North Sea, pretty shallow water, 80 meters of water, pretty shallow reservoirs. They're about 800 meters down. And we've got an awful lot of oil in place. There's well over 500 million barrels of oil in place discovered in those reservoirs. You might wonder, why have they not been developed before? The answer is actually pretty simple. They were viscous oil. So, not super viscous. It's kind of our core field pilot. The oil ranges from kind of like olive oil to engine oil, that kind of range.
Yeah.
So that makes it a bit harder to develop the oil field. We got great rocks. It's always good to have great rocks, but the oil is a bit viscous. From my perspective, that's fantastic, because what it meant was other companies have spent $90-100 million putting holes in the ground, establishing exactly where all the oil is. They decided they couldn't work out how to develop it. And it meant that this license was in open acreage and I could just apply for it from the government and take it into our company. So that's how we got our licenses. And that's how we've got licenses that are actually appraised to death. Nobody needs to drill a wildcat exploration well here. We don't even need to drill an appraisal well on the pilot field. We don't need to spend any more money finding out what's there. We just have to come up with a really good way of getting it out. And sorry, Phil.
No, I was just going to ask. So the viscous field. So we're talking APIs equivalent of what sort of number we talking?
So the range is 12 to 17, but roughly speaking, it's 13, 14. Most of it. It's very like Kraken oil.
Yeah, Kraken. Okay.
It's got the same sulfur content, same API, same TAN number.
So to stimulate the well, to get it flowing, I believe you have some sort of polymer technology. Do you want to just talk the listeners through how you would stimulate that well?
Yeah, let me talk about polymer technology. So brace yourself, because I like to talk.
I'm going to pour a glass of wine. Okay, let me
perhaps two even. Yeah. So if you think about it, if you got a nice big slab of sandstone, it's full of oil. You put water into it. What happens? The water just fingers through the oil. Yeah.
And to get the oil out, you keep pumping it round, pumping it round, pumping it round. And each time a bit of the oil comes with you. So recovering viscous oil with plain water is a slow, laborious, high energy process. And, people do it. That's how Kraken was developed. That's how Mariner was developed. And actually, a field that I put the development plan together for, the Harding field, BP's first viscous oil development in the North Sea, that's how it was developed. But there's a better way to do it. And the great thing about this is that it's not new technology. It's an old technology. It's been around 40 odd years. It's been used onshore in Canada, so on and so forth. And what you do is you add just a little bit of polymer to the water you're putting into the reservoir, just 0.25% of polymer, and that viscosifies the water. So it turns it from, plain water is 1 centipoise. This turns it to 25 centipoise. And that slightly thicker water doesn't finger through the oil. You stabilize the flood front and you kind of get a piston-like displacement of the oil out of the reservoir. Yeah. And what it does for you is you actually get more oil. The recovery factor will probably go from 30% to 40% because of using polymer. And more important for the economics of the project, you get a shorter field life and you have less fluid to handle. And here's the thing, that actually helps reduce emissions. So compared to a water flood of our fields, roughly speaking, typical water flood of a viscous oil field would have emissions of 30 kilograms for every barrel of oil you produce. Using polymer roughly halves that. And in fact, this goes back to what I was saying about the industry being vilified and so on and so forth. When we took our plan to the Oil and Gas Authority in September 2020, we were quite smug because we'd managed to halve emissions by using polymer. And we thought we'd got a really good plan. And they said, yeah, Steve, we really like your plan, but actually we want you to do even better on emissions. We want you to get the emissions down even more. So we went away and we thought about it and we did what engineers do, which is be ingenious. That's it. That's where the word comes from. We looked at the efficiency of the power generation systems. So we found some really efficient reciprocating gas engines. That sounds very grand. What it really means is a bloody big diesel engine like you'd have in the bottom of a boat, but converted to run on gas. And the good thing is they're really efficient, 49% efficient. And then in terms of managing process heat, we got a much, much more aggressive process heat management scheme. So we don't just have heat exchangers like everyone does. We've got heat pumps built into the process, proper big $5 million heat pumps. And that got emissions down again, roughly halved them, down to 5.9 kilograms of CO2 per barrel. And then we've added into our development scheme a floating wind turbine. And that gets our emissions halved again, down to 2.6. which is an eighth of the North Sea average.
So basically, this is the drive to net zero, and also with the element of renewable, non-reliant on electricity. You're going to be generating the energy from wind.
Yeah, the central North Sea is a very windy place. It's an oily place. It's a windy place. Yeah, and you can capture actually a lot of energy with a floating wind turbine out in that location. Yeah, and we can put it to good use, pumping the fluids around on our development scheme.
You just talked about floating. So do you want to talk about the FPSO element of it and how the production would work?
Our reserve auditors say we've got 79 million barrels of 2P reserves in the pilot field. So that's proven plus probable reserves. So it's 58 proven, another 21 probable to make 79. That's a really big number.
And we'll come back onto the numbers later on for sure. We'll analyze those and what they mean. But let's talk about the production.
Yeah. So how we're going to produce this is first of all, we'll drill a lot of wells. That's one of the keys to getting good recovery in viscous oil development. You have a pretty high well density. We only need 5 to start, but we'll have over 30 wells. And
is it vertical or is it going to be a horizontal technique?
Long horizontal wells. That's the key. That actually, if I go back to 30 odd years when I was working on the Harding plan, one of our big innovations was to use horizontal wells there. It's really standard now. It's not an innovation. It's making use of good technology. So we'll have lots of horizontal wells alternating injection production wells, and we'll drill those from wellhead platforms. The water depth's not so much, so we can have jack-up rigs come in and drill the wells. That keeps the cost down. And then we'll process all the fluids on an FPSO. So we're currently talking to actually 3 FPSO providers and trying to work through with them the best proposal to deploy a refurbished FPSO on our development scheme.
Yeah. So once the wells, say, moved into stimulation, into the flow stage, where you do what's known as a flow test, what sort of numbers would you expect to get from some of these wells in terms of once you've providing that the polymer technology works, you stimulate it, what sort of numbers would you expect?
Well, the great thing about the polymer technology is that we've got a really good analog here in the North Sea. But let me get back to your question about rates. I said earlier that other companies had spent a lot of money appraising this field. One of the things that they did is they actually drilled quite a short horizontal well, about 680 meters long. Our wells will be 1,500 meters long. But they drilled quite a short horizontal well in what is actually the most viscous part of the field, so where the oil is most viscous. And that flowed 1,800 barrels a day, which is more than a commercial rate. The great thing is we've got proven that we'll get commercial rates from these wells.
Right.
And, in the south of the field where the oil is less viscous, we'll expect them to come on around about 5,000 barrels a day, something like that. Maybe even a better than that right at the beginning. But once the water starts to come, the oil rate goes down. The key thing for our development scheme is back in 2013, Chevron, who were then operating the Captain field, which is another viscous oil field in the Outer Moray Firth, they went and did a trial of polymer flooding on a well pair in the Upper Captain Sand. Right. So really good analog for us. Same porosity, same permeability, pretty much the same depth, same temperature, all these parameters that really matter. And they injected polymer into one well and produced oil and eventually a bit of polymerized water from another well. They got a 15% uplift in the recovery factor. It went from 36% on the water flood up to 51%. What's most dramatic is, they actually started with a bit of conventional water flood. They did that for about a year. Then they started injecting polymer. Within a year, they'd recovered all the oil they expected to get over the whole water flood field life. And in 18 months, they got the extra 15%. It was the pace at which they got the oil that's so dramatic. And they actually published a fantastic paper on this. If you're interested in polymer flooding, read Poulsen et al. From 2018, published by Chevron about the Captain polymer flood pilot. And in that same year, they announced that they were going to do a polymer flood of the whole Captain field. Actually, they started with the platform wells. Then Ithaca bought them out. And now Ithaca, just the beginning of last year, April of last year, they approved another 400 million to polymer flood the rest of the Captain field. And Captain's a great analog for us. And that's given us a lot of confidence that polymer flood is the right approach for pilot.
Always good to have a reference.
Absolutely. And a reference in the North Sea and a reference offshore. It's actually, this isn't a trivial point. One of the biggest issues with polymer flooding offshore is the logistics of how do you get the polymer there? How do you mix it? So on and so forth. And, Chevron have done all the work for us. They've cracked that problem. You transport the polymer in an emulsion form, so you can just pump it. It's just like transporting diesel offshore. You put it up in hoses, store it in tanks. They worked out the systems for mixing it with the injection water, how to monitor the viscosity of the. We can, we like to say we look at their project and are very happy to copy and steal their ideas.
Imitation is a serious form of flattery.
Yeah, they did a great job. It's a fantastic job they've done.
Just on that point that you were saying, Steve, the Ithaca then got bought out as well, no?
They got bought out by Delek, which is a big Israeli company. They have the Tamar, and actually they just sold Tamar, but the Leviathan field in offshore Israel, massive gas field.
Yes.
And so
it's offshore. it's offshore Egypt as well. There's a bit of a fight going on there, isn't
there?
Yeah,
but they're selling the gas from Israel to Egypt, so that's good for peace. Let's say
because part of it is in the Egyptian part of the Mediterranean, part of it is in the Israeli part, I think. So it's like because BP have got a huge field there now, operating out of Egypt as well. So
with ENI as well.
Yes, I think so. Yeah, ENI is the Italian guys, is it?
Yes, that's right. No. Yeah.
So basically, there is. You mentioned 79 million barrels very flippantly, but that's a hell of a lot of oil in P2, no?
Yeah.
Okay. If you were to tell me at oil $110 a barrel, obviously it's still in the ground. How much is this 58 million proven worth per barrel, do you think?
Well, I won't tell you at 110, but what I'll do is I'll tell you what it's worth at $80 a barrel, because when you look at the forward curve, that's 75, 80 is where the forward curve's headed even today, 5 years out. So at $80 a barrel, the pilot project is nigh on $1 billion of value. So that's around about $15 a barrel is what the discounted net present value of the project.
So the discounted net present value of each one of those barrels should be 15 US.
Yeah, roughly 15.
Okay, and what about the probable then?
Well, so actually that's for the proven plus probable. So I don't have the number for the proven off the top of my head, and I never like to quote a number without being right about it. So I don't do that.
Okay, but if we were to use those numbers anyway, and instead of 15. We took a very cautious look at it and said, we're going to use half of that. We're going to use $7.50 a barrel. At $7.5 per barrel times the 79 million that you currently have, that would be $592 million of resource
that
your company has.
Yeah. When you're having it, when you look at deals that are done, if you've actually got a project that's ready to go, financed, approved, about half the NPV isn't a crazy number to use for that.
Yeah, for somebody to buy it, yes.
For somebody to buy it. When you calculate that NPV, it kind of slightly ignores all the risks, And when you're doing a project, there's risks in execution, and you can have cost overruns, you can have delays. Things can go well too in projects. Only ones I run, but that's sort of beside the point. There is risk, so companies won't generally pay the full NPV of a project.
No, for sure. But even a discounted NPV,
crazy number.
Half's not a crazy number, and the reality is that would also take us back to the full discounted NPV on maybe $40 to $50 a barrel as well, which means if really oil suddenly starts gushing out of every hole in the ground, which is highly unlikely, then you're in that situation. Yeah. But what that means is that the actual resource that your company holds currently, which is proven and some probable, but the majority is proven, 58 million barrels of oil. The value of your company's resources is £435 million. Now, that's at half the discounted NPV. Now, your current market cap is £22 million. So there's a factor of 20 differentiating those two figures. So what have you been doing? Why is your company only worth £22 million is the question.
It's because the world hasn't realized we're there,
Okay. You've been hiding under the North Sea by the looks of things.
Absolutely. Well, you can tell I'm a shy, retiring type,
I can tell basically you came to market last year in July when oil was the pariah.
Yes.
Okay. Nobody wanted it. And now we're in a situation where, hey, we want energy security in the UK. Do you think 79 million barrels of oil will add a touch of oil security, energy security in the UK? Do you think that's
absolutely?
Quite a significant amount?
Domestic production matters. It really does. And, it matters for all sorts of reasons. But, just talking about the value of the company, our share price today is roughly 40p. That's what we listed at. The oil price when we listed was in the 70s. We're now in the 110s. Everyone has realized that actually you have to have domestic production. You need some energy security, and there's nothing better than having your own production. Relying on Russia for your production isn't smart. It's not smart to rely on the Middle East. It's not smart to rely on Venezuela. It's much better to produce it yourself. But there's actually an important environmental angle to this as well. So, when we went to the Oil and Gas Authority with our plan, we were really happy with it. They told us, go away and come back with a much better plan, much lower emissions. We did that. Our emissions are right at the low end of the lowest 5% of global oil production. So it's absolutely true to say that investing in the new clean production that we can have in the UK, that has to displace some other barrels in the market. And the barrels it knocks out are the high cost, and that means high emissions production elsewhere in the world. So actually developing new clean production enables a reduction in global CO2 emissions. You'll never get an activist saying that. They just want to stop everything. But what happens if you stop everything is what's happening today. The price goes up. What happens when the price goes up? It means the shittiest little well in Oklahoma just keeps pumping away, at 99% water cut, and you're spending an awful lot of energy and a lot of emissions to get a tiny amount of oil out. So it's really important to continue refreshing the global oil supply and to have clean production coming on stream and displacing that old, not so clean production.
Yeah, and the North Sea still has literally billions of barrels of oil to come out.
Absolutely.
Just getting a bit trickier to get it out. Hence,
you've got to be innovative. All the simple fields are done. So
low-hanging fruit's been picked, as they say.
Yeah. So there's, the likes of Rosebank. That's a big development, but it's in I think 1,100 meters of water. 1,100 meters is a very long way down, right? These deep water fields are pretty challenging. Small fields are really challenging. Here's the thing about a small field. Typical small discovery just has one well on it. And you're trying to extrapolate everything from that one well, because if it was bigger, it would have room for two wells, So often, you go to do a small development and you can get a nasty surprise. Your big disappointment. Sometimes it works very nicely, but sometimes you get a nasty surprise. The great thing about Pilot is it's over a pretty big area. There's a lot of oil in place. There's 260 million barrels of oil in place. And we can see it really well on the seismic. There's a big, shallow reservoirs, high porosity reservoirs, massive advantage in having one of those.
So you talked about 260 million there as a number. Obviously, there would need to be more drilling done to book those or prove those reserves.
No, sorry, that's the oil in place, Phil.
Yes, yeah.
So the 79 is the recoverable.
Right. Okay.
So we don't need to put any more holes in the ground to prove up the 260 odd million barrels. Okay. Yeah. Actually, one thing we've done since we listed is that we licensed a new seismic data set. So, this was seismic that had been shot in 2012. We were previously using an older data set, and it's been reprocessed just the year before last. Really good work on it. Much better clarity in exactly where the reservoir is. And, we'll be updating our CPR with the results of that in a while,
Yeah. And you've also got other licenses, right, within these similar areas.
Yeah, just to the south is probably the most important license. There's a couple of discoveries there, LK and Narwhal. They've got 50 odd million barrels of 2C resources. So that's contingent resource. To turn those into reserves, there's a couple of things we need to do. One is we probably need to put a few more holes in the ground. So we'll need to do some appraisal. And the other is to put together the firm development plan. We already have a conceptual development plan. We know they're really economic, but we need to do those two things before those can become part of the overall development scheme. Actually, if you look at all the potential and add up all the risk resources and so on and prospects, we could be producing 250 million barrels from these licenses. That's absolutely within the range of possibility without having much more than a fair share of luck.
And just coming on to something else we touched on earlier on about prices of oil, it was only less than a year ago, would you believe, where US oil dropped negative, if I remember rightly, and they were actually paying. It
was March 2020 that happened.
Yeah. So
it's seared in my memory.
I mean, how did you ever think, right, that it would recover? I mean, surely it had to recover at some point, but you can't imagine that ever happening. I mean, that was unthinkable.
It was an unthinkable thing that happened. The world shut down, but in a way, I wasn't depressed by that. I was, I wasn't excited by it either, right? There was a very interesting thing that happened. The entire world shut down. Everyone was locked down. And do you know how much oil the world was consuming? It was still consuming 80 million barrels a day. It normally we produce and consume about 100 million barrels a day,
sure,
even with the world shut down. But you can't shut down completely, otherwise people die from starvation, So the world was still consuming 80 million barrels a day. And actually, the market balanced pretty quickly. We went through 2020 with, pretty low prices in the 50s and so on and so forth.
I remember some analysts saying that we'd never see $100 a barrel ever again. And then you look at it now and what the 139 figure, you just think, wow, it's amazing how things change.
Yeah. Analysts are sometimes well named. So there's a guy called Anatol Kaletsky. He's an economic commentator of some repute. Yeah. Back in 2014-15, when the oil price crashed from 110 down to $30 a barrel, he wrote that $50 a barrel was a ceiling on oil prices and it would never go through that again.
Yeah.
It's hardly ever been below 50 since then. So it turns out 50 is actually a floor. And he was arse about face because he couldn't tell the ceiling from the floor.
And the interesting thing about oil in general is for the last how many years, you can probably tell me better than I can say it, but certainly the last decade and probably longer, there's been such an underinvestment in the production of oil and the resource of finding more oil that even all the majors now have probably got less oil on their books to recover than they've ever had. Maybe that's not true, but I think it is.
It's absolutely true. It's absolutely true. And, since it was the oil crash in 2014, at the end of 2014, I remember it vividly because we got our license in November 2014 and the oil price was $110 a barrel. And I thought, we'll be able to flip this pretty quickly. And in January, it had collapsed. The oil price had completely collapsed and the world had kind of changed. Since then, I tell you what happened. There was kind of two themes. In most of the world, investment in new developments was grinding to a halt. In the US, the shale boom carried on for a good while. And actually, the shale oil industry in the States managed to incinerate quite a lot of investors' capital to the point where a few years ago, really the investors called a halt to it and said to the industry, you got to return capital. So there was a kind of restraint in the shale oil business, and there's been no significant big investments in oil and gas developments. And the big companies have been stepping back from it. They're not they haven't been interested in doing new oil and gas developments. They just want to transition themselves into being renewable energy companies, which is a laudable goal. That's great to do that. But you can't neglect the oil and gas business. And you need to keep investing. Otherwise, production declines. And you get yourself in a state where actually the price goes crazy, as it's just done.
I think ultimately, as we go through peaks and troughs of demand in oil, we're going to continue to have this volatility in the oil price.
That's the one, Kevin, that's the one thing you can bet your life on. The oil price will be volatile.
But at a much higher level than people anticipated.
I think there's been a shift, like in 2014, 15, there was a shift down. We've reached a point where actually there's a shift up. We're in that supply constraints phase of the cycle. So, this is the time to be investing in development projects and getting new fields on stream as quickly as you can.
What would be the dream? What is the dream for this company, or the dream for you and the company?
We're working in lots of different ways to try and get this project financed and off the ground. And we're looking at what debt packages we can put together, what bonds you could do. We're looking at an infrastructure investment option. We're looking at farming it out to other companies, so on and so forth. Towards the end of 21, I got very focused on us executing this project ourselves and putting a project team together, finding capital from every source possible to make it happen. And I was confident we'd be able to do that. And I thought, I'll get to run this project. Now I'm beginning to think, well, maybe that won't happen. Maybe I won't get to run this project. Maybe another operator is going to go, oh, crikey. This is a bit closer to getting government approvals than anything else that's sitting out there in the North Sea. And maybe we should have it, or have a piece of it and farm in and take over as operator.
So would I be right in assuming then that the data room is open?
The data room's always open. Anyone who tells you they closed their data room is bullshitting you.
Yeah, I don't know an oil company where the data room's not open. Isn't that true?
Yeah, there you go.
All right, then. The data room's open, but there are people in the data room, should I say?
These things go in phases, and I don't talk about them much. Cool. And that's the nature of this bit of the business. Yeah. The first rule of financing an oil and gas project is you don't talk about financing an oil and gas project.
But we've got to ask, right?
Yeah. Well, you've got to ask. But then
might not get an answer. But the interesting thing is, Steve, how much of this company do you and your close proximity family have?
It's about 57%.
Okay. And how much is free floating in this company then? Because if you've got nearly 60% of it, then...
The shares not in public hands, as stated on our website, is 66%. So there's apparently a third of the shares. Yeah, but some of those are in very sticky hands. They don't fall into the not in public hands definition as per the AIM rules. But some of the hands are very sticky. Like the shares my kids have are very sticky, and the shares that RAB Capital have are pretty sticky. And here's the thing, Kevin. What matters to me is making sure that we get this project going. And do you know what that means? Yeah. I'll have to dilute my shareholding to make that happen, one way or another, at the asset level or the company level or whatever. But I'll do that in the way that minimizes the dilution. So, if you want to invest in something where the CEO is going to minimize dilution, you have to have some dilution, otherwise you can't do stuff.
It's very tightly held. Basically, in terms of its ability to be valued, we halved the proven and probable resources in value from $15 a barrel to $7.5. That gave us a value market cap. If someone came along and wrote you a big check of £435 million, and your current market cap is 22 million. I still want to ask you, how? I don't get this. This doesn't add up.
Well, I tell you, part of the problem, Kevin, is actually, there's maybe not enough shares out there, and not enough people know the story. But, that's part of the reason for coming to talk to you. It wasn't just... Yeah,
it's not about... I don't think it's about the number of shares. It's about the fact that people don't know about this. That's the reality.
Yeah.
Exactly. So hopefully when they listen to this, they'll be, some of those 6 to 9 million shares I should put in my ISA or pension and could make a lot of money.
Look at the current price, around 41p. It's very close to the admission price, which was 40 pence. So you're actually getting in at almost basement levels right now.
Well, absolutely. And the oil price has gone up, $30 a barrel.
Well, we worked out that when you listed in July, I think it was around $72 to $73 on the barrel, and now it's around the 110. So it's the investment case has just got much better.
And we had some really important things happen to the company just at the end of November, early December. So one was and it doesn't sound like a very big deal, but the Oil and Gas Authority wrote us a letter of no objection to our selected concept. And that sounds really dull and not a big event, but actually, since they started to focus on all these net zero objectives, it's become a really big deal to get that letter. So we got that letter at the end of November. And then we actually won a competition that the Oil and Gas Authority was running about how to electrify existing platforms in the North Sea. Not the ones we're planning, but the ones that are currently supplying gas to and producing oil. And there were 29 companies went in for that. There was £1 million to be had. We got 470,000. There were a couple of other winners, but we actually won the most amount of money. So I say we won the competition, right? And we're just about to deliver a report at the end of this month, maybe just a week or so's time after that, a report to the Oil and Gas Authority about how to do that. And what we're actually trying to do is create another business opportunity, because we're just entrepreneurs and engineers, and we're trying to combine those two things.
And I believe there was a farm out on the Carroll prospect announced as well.
Yes.
Can you just talk a little bit about that?
Yeah, that's a really interesting thing. So it was a part of the license that we weren't really paying a lot of attention to. And we got a lot of work to do on the rest of the licenses we have. So we were approached by a company that knows that area really well. They've been working in and around that area for probably 20 odd years. And there's a prospect that's actually sitting on our licenses that they wanted to get some seismic and work up some seismic and then market the prospect. And we're continuing to work with them to see if we can close out a deal for them to do exactly that. And, we're looking at things that we could do that could improve our access to data over all of our licenses. So there's more to come on.
And that's got an estimated, 30 million barrels or something?
Yeah, like that? It's a roughly 30 million barrel recoverable prospect. And, they're going to farm in for half of that prospect. But they'll only really get anything out of it if they can get a well drilled on that prospect. And that would be a big help to us.
One of your licenses, if I remember rightly, is in partnership with Parkmead PMG.
Yes,
isn't it? Because I remember I've been in this game for a long time, and I remember Tom Cross of Dana Petroleum fame when he sold them out to, I think it was the KNOC, the Korean National Oil Corporation.
Fantastic deal.
What a story that was, hearing of an Irish woman who bought 10,000 shares when, forgot about them and got a check in the post for something like 200,000 euros, 10 years later or something.
Yes.
I love hearing these stories. But tell us a little bit about Parkmead and your relationship with them.
I don't actually know Tom that well, but the chap I did know really the best, Colin Percival, has moved on to another company. So Colin and I have known each other since we were both posted to San Francisco in 1983. He's actually quite a bad loser at Trivial Pursuit. But anyway.
What favourite round? Did the entertainment or history or science and nature? What was his favourite category?
He actually accused us of going through the answers because we were so good at it. Anyway, this isn't really answering your question. But maybe it's entertaining the listeners. Anyway, Colin's a great guy. Probably one of the best geologists I've ever worked with, beyond a shadow of a doubt. Definitely the best sedimentologist, right? And he and I saw this opportunity to get into actually what's a really big oil in place. We're not sure how viscous it is. It's going to need appraisal opportunity in the Outer Moray Firth. So we did a joint license application with Parkmead, and we're continuing to work on that. We probably need to do a bit of fancy footwork to make sure that we get access to all of it at some point. But it could actually be a real humdinger of a project. It's longer term than pilot, but Parkmead's a very good partner to work with. Tom Cross has delivered a lot of success for people. And there's still a very good team working in Parkmead, even though Colin's moved on.
when we talk about this program, we talk about the roast. What is your Sunday roast, Steve? If you had to have a choice, what would it be?
It would definitely be beef.
Okay.
Beef and a nice bottle of red.
Yeah, absolutely. I think my wife would prefer lamb, but we wouldn't fight about it.
Beef and roast potatoes. And Yorkshire puds.
It's got to be Yorkshire.
Well, to be honest, Kevin, I'm trying to cut out the potatoes. I'm trying to cut out the carbs. I may still be fat as a barrel, but it's a smaller barrel than it used to be. And
I wish I could say the same thing.
Yeah, I'm cutting out the carbs. I'll do 20 minutes on low carb diets as well. But that's for another time.
Keto diet and all that lot.
Yeah. I like
meat. Eat more meat, basically.
Yeah. So plenty of beef, not so many potatoes.
And for dessert, what would it be?
If I'm going to go low carb, my dessert ends up being frozen raspberries and double cream.
I like that. There's a lot of fat in that double cream. Don't
but that fat's good for you. That's the whole point. The fat's good for you.
Okay, I'll go and eat the bar of lard now as we speak and see if I lose any weight.
The best thing you could possibly have.
Indeed. Well, it's quite obvious your company is massively undervalued. So let's hope the market wakes up to your potential here. And no doubt we'll be talking to you again. And, one of the things we talked about maybe is we'll have some sort of investor night with you guys and talk about the potential in more detail with individuals. So we can maybe do that in a number of weeks. And we wish you all the best and hope the project continues to move on.
Steve Brown, CEO of Orcadian Energy. It's been an absolute pleasure.
Thank you very much indeed.
Good. Well, that was interesting and enjoyable. He's a nice gentleman, isn't he, Steve?
Yeah, no, Steve's a good guy, and obviously saw the opportunity in 2014 to buy something that already had proven resources. And I think this was at a time where the North Sea was not exactly the best place to be buying. And now it's come to fruition, really, isn't it? Do we need energy security?
Sure we do. And I think you just delineated the difference between this is not your average wildcat driller where you get a duster and, the share price drops 80% in the morning session when they announce it, and this is actual proven reserves, bookable reserves with an amount that we talked about up to potentially 400 million pounds worth of oil there. It's just about getting it out, and they know the technique, the proven technique that Chevron have written about these polymers, and they've got all the technology to do it. So it's a no-brainer, really. Yeah,
and as he said, it's very green with the electric from the wind and the use of the gas. I think
net zero
it's going to be very, very low. And as he said, it's going to take off some of the very not very green barrels of oil from somewhere else in the world. So it's got to be a good thing. I mean, we're going to need oil, even though we want to have a green economy. The politicians have gone with the world, which says we want to be green, we want to be green, we want to be green. But the reality is that it can't happen as quickly as any of these activists or anybody says. It's an impossibility if we want to continue to have the sort of energy security that we require. It's not possible. That's another reason why is it Mast is one of those companies that's doing the same thing, isn't it? It's creating some form of energy security.
We're going to go on to talk about have a review of the 12 stocks. Is that what we said we'd do?
Yeah, I think let's have a look at the 12 stocks. It's been tumultuous last 2 or 3 weeks. At one point we were 40-something% up on those 12 stocks. We are most definitely
how they looking now?
Definitely not 40% up now. But we're still doing well. The holdings are now up 23.25%. So today's been a good day, I think, in terms of all of those stocks collectively are up over 5% today. So today was a good day across those sort of types of investments.
Yeah.
But from top to bottom, let's go through them. I mean, the first one and the one that's leading the way is Cloudbreak. What do you think of Cloudbreak for?
Cloudbreak's been remarkable in terms of, sat at 1.5p for a long time, which is 3p IPO price. People were just almost losing it with it, weren't they? And even I looked at it and thought, how can this be just half the price of the IPO? And then all of a sudden saw an increase in volume, and it hit 13.5p at its high. And I was just like, I think you and I were just like, what? Wow, how has this happened? It just sustained buy-in. I think some Swiss investors came on board. Kyler took another sort of like 12% up to his stake to about something like 23% of the company or something. He holds a significant portion of the company. We interviewed him. He's done many, many more, joint venture type agreement. He's found more projects there, a lot more in West Atlin, Klondike and all state line. So there's been many RNSs, and I think the market is waking up to these and starting to understand these project generators and royalty generators now. So it was massively undervalued. It got to 13.5p, which you could argue was maybe a little bit above its station in terms of the valuation right at that point. And what I would say is I think our target on there was something like 5.5 pence, and it absolutely smashed it at 13.5. So I think we made a decision earlier that we're not going to remove it from this, but what we're going to say is tick, that one's hit its target, so we can now add a new one into the place of that one, right?
Yeah, that's right. And
we'll announce those at the end, the ones that we're going to add.
Yeah.
There's an announcement this week that they've moved into this ICE4 project with the number company. So this is a company that they've already had, actually effectively projects optioned within the past. So they've obviously got a good relationship with them, and it's about 90 kilometers south of Atlin in British Columbia, and he's part of that Northwest portfolio. So yeah, very, very, very good. It's great to see them still doing these 75% interest in the project with the number co for a spend, and then they obviously also get the royalties or the net smelter royalties as part of that, and obviously common shares in the project. So it's a great model.
Okay, so the next one I'll talk about, and that's Ben's Creek. Hit our target, which was 80p. It's hit 85p as an all-time high so far. You sort of have to pinch yourself a little bit from 10p IPO in I think it's October, so already 7 bagged and more. But when you actually crunch the numbers and look at them, the metallurgical coal price, which I think was $450 today, or $450 for a metric ton, so maybe a short American ton, about $405. The margin now is just astronomical. When we did our sums, it was $150 and $200 was the margin. The margin could be touching $250 to $275, exponential increase in terms of its value. I think there's no reason on earth why that share is not worth at least £1.50. But again, it's hit our target. So we're not going to replace it, but it means we're going to have our top 14 stocks now, because those two have both hit their target. There should be continuing news coming forward with Ben's Creek in terms of production and what's going to be happening with the railroad, what's going to be happening with the wash plant. So we should have a very news-rich period of time in the next couple of months.
There was in-depth testing going on at the wash plant, the last update, which I think was the 25th of Feb, and the railroad. So there should be something coming, I'd imagine, pretty imminently, because I think he talked about 2 to 3 weeks for that, the testing phase of that. So that should be something to look forward to, in the next few weeks. And as you say, I think anybody who listened to the show and actually, who was invested from the 20, 30p stages will have done extremely well out of Ben, and will continue to do well going forward, because it's only just started, really, hasn't it, the story?
Yeah, I mean, when I looked at the figures again yesterday with a $200 margin to do 1 million tons, which was Adam's stated aim. So annualized 1 million tons at $200 margin. I think the share price worked out with a PE of 6 at £3 and something, £3 and 12p. So from now sitting at like 73p, that could still be 4 bags from here. And that's without any further extensions and different things. So yeah, the potential is amazing. And, let's hope it just continues on rolling. I mean, I don't see many dangers, even if the price of met coal falls. It's really not going to change that much in terms of how things are going to progress with Ben, because Ben is basically going to be a cash cow. It's just going to produce the coal and produce huge amounts of EBITDA. It doesn't matter if the coal price dropped $100. I don't see that it would affect the share price very much at this moment in time, because it's not priced in yet, because obviously the production is just about to hit the trains and roll out. So yeah, so that's Ben. The next one in terms of performance is African Pioneer, up 44.5%. What do you think about African Pioneer, Phil?
I think it's been very good. I mean, it's dropped back from, I think it was over 100% at one point. It hit something like 4.3p or 4.4p, maybe even higher than that, 4.7, if I remember rightly, which wasn't that long ago. So yeah, it's still below the IPO price. I think the IPO price was 3p, if I remember rightly, or 3.5p actually. I think
it was 3.5. Yeah.
So it's still well below the IPO, which is a bargain. The last update we had was the 9th of Feb, and that was the Ongombo project update from their prospect in Namibia, related to the scoping study and the project design engineers at New Horizon, and obviously the potential open pitable oxide sulfide mineralization, which have been identified. So yeah, all to play for there. Still bargain, up on what we said. I don't know how far, what the target on that one, if I remember rightly, was 6p. So it hit about 4.85. So it wasn't far off, but I do firmly believe that, it will still get back there. It just needs a little bit more news. And again, as we've said on this whole resource sector, people to really understand, and copper's bust through all-time highs in the last couple of weeks, but yet none of this is being reflected. I know they're not a producer, but it doesn't matter. The fact that they've got these assets should still be indicative of some sort of valuation on it. A bargain, even at 2.8p for me.
Yeah, and two majors involved, well, big.
Yes,
big companies.
Sunfire and First Quantum there, and yeah, absolute. Show me another stock and on the main market that has got joint ventures or partnerships with two majors. You're not going to do it.
Yeah, and a 15% shareholding of the stock also for Sunfire as well. So
yeah.
Okay, the next one I'll take, which is Contango Holdings. There's a theme going on here, and it's metallurgical coal, because both Ben's Creek and Contango, metallurgical coal. Ben's Creek now has a market cap of what must it be now? 350 times 70 is what? 250 million pounds. Yes, it's in the US. Yes, they're going to production straight away. But you've got Contango Holdings, there's, I think, just over 20 million pounds, and has significantly more metallurgical coal. Difference is it's in Zimbabwe, but it's going an extra step. And that extra step is that they're going to produce coking coal, or coke, and that will increase their margin even more in terms of when they sell this coking coal through these coking batteries. So they are going to be producing coal out of the ground in the next few weeks, literally. There's different things that could be happening, offtake agreements to take some of the coal before the coking batteries come into play at the end of this year. But I've just actually written a report, and that will come out next week. You'll probably get it on Tuesday or Wednesday if you're interested in having a read of that, just about values and what I think is fair value for this stock. We had 18p on this stock, I think it was, as our target. I have fair value of 15 to 18p right now before any of this other stuff even happens, just purely because of the price of the coking coal, $620 to $650 a ton. It's huge. The margin for digging up the coal, sticking it through the coking plants, and then selling it for this, the margin's got to be $250 to $300 a ton. So it's absolutely massive. And the potential EBITDA on 150 plus the 30 or 40 that they will have, 190 tons of coking coal by probably end of next year. I don't even want to do the maths because I did it in the report, but it's huge. So yeah, let's move on to the next one. The next one then, Phil, is Extract Resources. It's up 7%, but really has fallen back from highs.
It's been a bizarre one, really. I don't know what to make. I'm not saying make of it, but I don't. Yeah, it's strange because it got up to 7.5, was on a really good tear, and then now you look at it and it's sort of dwindling down in the sort of low fives. I just think, for even just looking at the Manica project, the actual gold royal, the pores and the production from there, I think that surely that must underpin, if not more than the value of it now, right?
Yeah, for sure. No, I mean, it's going to have revenues, and pretty big revenues for the other projects that it has, never mind the Australian monster of copper project that they've got, which at some point in the not too distant future, they're going to have to sort of put the white flag out to AA and say, do you want to buy this or not? So that's going to happen. We're in the middle of March now. I think, when did Colin Bird say? Sort of April, May?
April, May time. They said that there was going to be to take the decision to mine / trigger the Anglo agreement, or the buyback agreement, which would be very interesting to see. But I mean, I think the problem is that the market has perceived it as being like too many drip fed assay results from individual holes. And I think that you have to do that. That's the way the company reports, rather than holding on to numbers, and that they've come under a lot of scrutiny, unfortunately, for doing that. Some people have probably thought, I'm sick of this, and they've gone their own way, and there's been that sort of reaction to it. But actually, I think they've delivered consistent results, and they've had to go to the boundaries on the northwestern flank to see how big the resource is. That's what they've been proving, right?
Yeah, no, all I can see is potential upside here. I mean, everything, as you said, is underpinned by revenues that are already there, and we didn't even factor in that the gold price has gone over $2,000 an ounce, which should actually increase the take on that situation significantly.
They've also got moly credits as well, haven't they, on or potentially could have on this as well.
Again, the market is a mystery at times, isn't it? But I think this was pushing 7-8p, wasn't it? It was definitely over the sevens, and then dropped back. And again, we have a target of, I think, 18p on that one as well. So yeah, we think still very positive it should happen. It's more a case of when. So we're moving on to the next one, which is Hydrogen Utopia International, which really should be in the spotlight at the minute. It's up 3% since we recommended it, but ultimately, it's fallen back quite a lot from its IPO sort of engagement. But the world needs this more now than ever after what's just happened. So I don't know what your thoughts are on that, Phil, but it seems a bit bizarre.
I agree completely. I mean, we need to be looking for different methods of energy, and drop our reliance on hydrocarbons, however you want to refer to them, on oil and gas, and also dependence, of course, from the country, from Russia and foreign suppliers. And I think, HUI and Powerhouse as well are an answer to that. So for me, it's a great technology. It's a disruptive technology. It's an environmentally sound technology, and it's an answer to a pretty grim problem we've got.
As it stands at the minute, they are the 2 for the 6 of the 12 that are actually up since we recommended them. Now, the rest of these now are down since we recommended them. So the first one is Seed Innovations, which is now 4.85p, which is hideously cheap, because the NAV on this stock is over 11 pence. So if they decided to wrap everything up, sell it on the market, you would have 11p in this company.
It's funny because it's mad. It's a crazy one, you see, because when we picked the stock, if I remember rightly, we looked at the price at the time when we actually made the list. Now, when we interviewed Ed for this, it moved something to like 7.5, 8p within about 3 or 4 sessions. So when we were chatting to him, but when it went out, we were referring to the share price at about 5.5, 6, but actually it was probably about 8.5 or 8, something like, around about 8.5. But it's dropped back again to the levels that it was when we were interviewing Ed back in December, middle of December. So now it's like, why has it dropped back? Because fundamentally nothing has changed, other than the fact that people have probably pulled the money out of the markets, and cash is king during a time like we've got the conflict going on. So really, this presents an amazing opportunity to get into what is a great fund.
And I mean, it's lower than it's ever been, I think, in the last couple of years. It's never been any lower than this, I don't think. So, and, you know, the big catalyst for this, from one of the reasons why we picked it, was Leap Gaming. And, you know, it's going to happen in the first half of this year, we think, anyway. And even if it's slightly later than that, so what? If you're buying this at 4.85p or 5p for the sake of argument, I really think the NAV, when Leap gets sorted out, is going to be sort of north of 20p, you know, because it's going to add a lot of value. I was chatting with Ed on the phone a couple of weeks ago, and he was raving about the German thing that he bought and Little Green Farmer in
Little
Australia.
Green Farmer just had a trading update the 1st of March, and the revenues were, the half yearlies were something like $7.3 million. It was great, and they own something like, they've got like 7.3 million shares in Little Green Farmer, which is about 3%. So very good investment. And also the humor element's very good as well. So, you know, Ed's making some really, really sharp investments in this company.
Yeah, as you said, Humor as well. Humor is one of the only companies in the UK that has already got its FSA license, or whatever it is, Food Standard Agency license for the CBD. So, yeah. Okay, moving on. We move on to Carroll Minerals, 13 or 14% down since we recommended it. No idea why.
No, just complacency and boredom and fear and usual elements of why we're at 12. Finished the day on Friday at 12.05 pence, which is frankly depressing. I think the IPO price was around this level, if I remember rightly, around 12.
I think it was 10p, no?
Yeah. 10 pence. I mean, it's frankly laughable at 12p, really, when considering that they've got a joint venture with Bezant Resources and potentially one that could come with Jubilee Metals, who are obviously quite a sort of mid-tier mining company. And we've been to site, and it's unbelievably cheap.
8 to 10,000 tons of produced copper, probably per month, starting this time next year, I think, is the reality of this situation. Plant being designed, as it said in one of the last RNSs, by Jubilee. So that would give us a good indication that Jubilee are on board, but not yet signed, because we can't actually talk about that. Or not talk about it, but we can't actually state it until they've got all the things back. And a lot of the things have been, the assays being delayed is causing this problem, I think. Like many of these things. Okay, so the next one's Love Hemp. I'll let you talk about that. It's 34% down since we that's recommended it.
Yeah, so the shocker, obviously, there's been a number of things going on. There's been accountancy corrections that have been needed, which they had to call an AGM for, or an EGM for. Then they've had an announcement, I think it was this time last week, after market. Always the worst time, put an RNS on a Friday after market. And that was regarding the certain number of different resolutions to call it an EGM again. So to remove a member of the board, the executive chairman, to reduce salaries, etc., to, you know, the whole number of different resolutions that need to be kind of voted on. And that will be open. I think you've got until like the end of March to do that if you're a shareholder. And I think just generally that having that sort of like that black cloud looming over them has obviously caused a significant sell-off down to, I think it's like 0.65 pence or something like that a moment, which again, for a company that's got, you know, strong revenues but negative EBITDA, is actually still very, very cheap now. You know, it's still very cheap for what it is, but obviously there is a significant risk going forward that maybe, you know, they could be taken over by, if this person, whoever it is, this fund who has 5% of the company, does get their way, and then the resolutions are not voted for but voted against, then there is a danger that somebody else has got a controlling hand in this company. It's like a concert party takeover. So that's the reality of the situation, and that's hence why there's probably panic spooked a few investors to sell off this week. I think it's I wouldn't say it's 50-50, because I still believe that the company are strong, that they've got a good product, that they've got the right contracts in place. But I think they've bitten off, unfortunately, more than they can chew in this last 18 months. And things are starting to come home to roost. So let's see what happens in the next, say, 2 months. It's a critical period for the company going forward, as I'm sure you would agree.
For sure.
But it's a sad story all the same to see where they are now in this current valuation of the company. So, yeah, I'm a bit saddened by it all, to be honest, as someone who's been a big proponent of the company. But I'm sure that Tony and his board can get through this, and it will all be good.
Yeah, I mean, I think if they get past this process, which I fully expect that they will, to be honest, from speaking to large shareholders of Love Hemp, you're looking at a market cap of about £8 million as it stands. And the last revenue figures were 4.5 to 5 million. And it looks like that's probably going to be increased this time around. So maybe you're looking at annualized revenues of 6 million plus with a market cap of 8 million. Okay, they're not making profit right now because they've invested a lot of money in new facilities to, they're not like other CBD companies in that respect, because
they're very much a growth company.
Yeah, but they do produce their own products.
Yeah.
They're not buying stuff. They are buying maybe the cannabinoid stuff in, but they're producing them themselves with the oil. So I think it's a long burner. I mean, let's hope it reaches our target, but obviously it's not had a very good start to do that.
No, I mean, there was an article that went out, we read, didn't we? It was put out in the Sunday Times last week, which really didn't paint a good future for CBD, unfortunately. So I'm amazed that actually Tony was referenced on the article. It's one of them things, but it referenced the FSA element, the novel foods, which I don't want to talk too much because we're conscious of time. But basically, there's been it's been a bit of a cluster with the way that the novel foods and FSA have done the whole approval of companies. They were meant to have been approved back end of March of last year, but it's just not happened. There's only been 2 or 3 companies anyway, and he said something along the lines of, we'll weed out the cowboys of the ones who've put some horrific applications in. And he also talked about things like, or the article referenced that the market really wasn't there for CBD. You read it as well and thought, mate, that's not the most positive articles, is it?
No, it wasn't a very good article, and it's not true either. I think there's a huge market for CBD,
there is,
and it's gonna keep growing. As more people get over the issue that it's not cannabis, it's hemp. And it still has a lot of those properties that can help people. Conroy's the next one, and again, let's talk about Conroy. The same as CMRS.
There's not a lot else to say other than it's screaming by at 20p, and why would it ever get there? They've got this joint venture with the Fortune 500 company, just beggars belief. I don't really want to say anymore. It's just crazy.
No, it's 39% down since we recommended it, and no legitimate reason why. The market is just nuts in terms of that. Massed Energy, again, 41% down. The baddest luck you could possibly wish for. It was on the move. It was over 8p. And, basically the Russians decided to do something, or should I say Putin?
Yeah.
And everybody sold off. It's now 5p for a company that, I mean, again, I've just finished the report. It's just been typed up and worked on, and it should be out in the next few days. The fair value for this is 15p plus. There is absolutely no doubt. And it's 5p. Yes. So, and can only really go up as well. It's like, as I said, I think I quoted it the last time we did this 12 stocks. It is the most boring 10 bagger you could possibly buy. And from 5p, I think it could be the most boring 10 bagger you've ever held. But could it get to 50p in the next 2 years? Yes, in my view.
Absolutely. And we're going to go to site in the next, probably, we're at March, so it's going to be probably towards the end of April. We're going to go and visit Pie Bridge, which is the one in the site in the Peak District, and actually see the site ourselves and have a look around it, and then obviously write a report based on that, or update the existing report. There's some, that you see the odd comments on some of these forums. Oh, it's just a building site at the moment, or a car park there, and we need to go there and dispel those rumors.
Yeah, those myths. Yeah, so for sure it's massively undervalued, and I have no doubt that when people start to understand what that's all about, again, it's energy security, isn't it? It's making sure that as the green stuff comes in, The wind and
the fact that the auction that when they're putting these peaking or these reserves to auction, that the auction, the amount that they're paying is at all-time highs, isn't it, for the kilowatt hours?
Yeah, they got 5 times what they put down in the prospectus that they thought they would get. So it's crazy. It's crazy. And then we move on to our worst performer so far, which is Chill Brands, minus 67% so far. So there's been a few catalysts to why that happened, because in the first month, this had actually hit 18p and was one of our better performers.
Did we call it the Mikey bounce? What would you call this one? The Mikey drop?
This is the Mikey flop.
The roast retread.
I spoke to him briefly last night, and I said to him, he's still on for £1.50, and he just said, ouch. So I'm not on for £1.50, but, it's not beyond the bounds of possibility that it could still do its target, which I think was 50p. But anyway, some reasons why this happened. One of the major shareholders, John Story, decided to jump ship, and actually he's jumped to Ben's Creek, which is one of our best performers. So maybe he's looking at these 12 stocks. I don't know. Or maybe he just knows Adam Wilson. I'm not sure. Anyway, so he dumped 13% of the company in about 3 days.
Yeah.
So the stock went from, I think, about 12p to 8p to 7p to 6p in that period of time.
Yeah.
Then the company have said nothing. And then they put another announcement out saying that sales that they should have put in last year, they can't put in last year because they didn't have the product to give to the companies, because they had disruption in actually getting the product to get to the customer. In other words, a car crash. So basically what has happened is then the shares have gone down even further to about 4p. They bounced back up to nearly 6p the other day, and now they're back around the 5p mark again. I mean,
market cap 10 million.
It sounds
revenues
crazy.
Of what they had a revenue RNS out recently. What were the revenues? Tell me through the revenues.
I think the revenue was like between $1 and $2 million. So let's say £1 million. Okay. Yeah. So from a revenue perspective, no big deal. From a £10 million market cap point of view, we believe that chill.com, the actual domain, is actually worth more than the market cap as we speak, which is just bizarre. But they have lots of products that are coming through. This is not a CBD company. This is a smoking cessation company. But right now, I have to be brutally honest, the CEO's not communicating, haven't communicated for well over a year. And ultimately, the PR is a disaster. They have not communicated what they're trying to do. And that's a large proportion of why this share is where it is. And if they want to sort things out, they've got to start telling people where the roadmap is. I have spoken to Callum, who is the guy in the UK, and he assures me that this is going to be coming online in the very near future. And if it does, I think, this stock could easily go to 10p in a heartbeat, just like Love Hemp could go to 1.5p in a heartbeat, if good news is on. So if you're into the high risk stuff, I'd have to say that both Love Hemp and Chill could rocket in a very short period of time, just with a little bit of news. It doesn't even have to be great revenues or anything else. These companies now are worth less than their enterprise values for sure.
Yeah,
like 100% less than their enterprise values. I've been a big rah-rah of Chill all the way up to £1, all the way back down. I still think it's got a great chance of success. They are the 12 stocks we've covered, and we are 23% or 23.71% up to be exact. If you'd invested £120,000, i.e. 10,000 in each stock, you'd now have 148,450 quid. Now, because two of them have hit their targets, we're going to add 2 more stocks. So which stock are you going to choose, Phil?
Well, I'm going to go with Orca, mainly because it's fresh. It's an IPO, round about the IPO level, which we talked about. It's at the 40p mark. So it's a basement level. You're getting in at IPO levels or admission levels, let's say, because obviously we talked about it being a previous company. And it's just, for me, that's, it's got a compelling investment case. The reserves being there, the P2 reserves worth around about 400 million, we said, at the discounted MPV, shallow fields, net zero, and very good ESG. It reduces the need for dependence on the foreign energy, which is very, very much, it's a hot topic at the moment. And as I said, it's still at the IPO price. So for me, put it in there, buy at 41p, and I'm going to put a target on there of £1.
Yeah, and I think that's very conservative, even £1. But yeah, I think the potential, as we've heard today, is enormous. Okay, and I think the one I'm going to add is Blenco Resources. We did an interview during the week with Blenco, and again, it's one that we don't have as in a resource. We don't have in this scenario of graphite.
Yeah.
It's got a huge amount of graphite in terms of in-ground amounts. I think graphite hasn't really peaked. One of the things we talked about in that interview was that the most in volume and weight that is required in an EV battery for an electric vehicle is graphite. It's like 50 kilograms of graphite are required for the EV battery. Yeah. And there isn't huge amounts of this stuff about, and there isn't huge amounts of new stuff being discovered. So again, it's going to be a resource in the future that definitely is required. And their project is massively undervalued, or it certainly seems like it. This company has hit 10p on numerous occasions, or twice anyway in the last couple of years. It's currently sitting at 4.5p, and I'm going to put a target of, I think, 12p on this stock by the end of the year or before. And I think it should do it easily. It's got a lot of value already in it. And yeah, I'd say listen to the interview. If you're interested, listen to the interview. Yeah,
we'll put a link into the description here of the interview with Mike Rolston that we did earlier in the week. But yeah, I think basically, if you've managed to listen to this show all the way through to this point, then well done. Have another glass of red. Enjoy your roast, and we'll wrap it up for the day.
Yep. Again, thanks everybody for listening, and we'll see you next week.
Have a good one.
All the best. Enjoy.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.